What's up, guys? Eric here. Some real talk today, unscripted, unedited. I'm going to talk to the camera. I'm going to talk to you and tell you what's going on with the stock market. So, of course, the market's selling off here. Started happening when Jerome Powell spoke last Friday, the Fed meeting, Jackson Hole, Wyoming. And I've been telling the Discord community, I've been saying for weeks, I've been pounding the table in chart day. Every Wednesday we do chart day, I've been saying, hey, don't chase, careful of FOMO. A lot of these growth stocks are up 30, 40, 50% from the lows. Just be really careful chasing here because the upside is pretty limited from here when you look at what's going on and you look at the meeting that we're going to have here in Jackson Hole. And so, of course, the market's going to do its thing. And what the stock market wants to see, the stock market wants to see the Fed pivot. Okay, so the Fed is right now, they're in the mode of quantitative tightening, which is historically never good for stocks. Plus, you have them raising interest rates to try to combat inflation. And inflation, even if it has peaked, the thing about it is we still have inflationary pressures that are going to linger. You look at like the 1980s, it lingered for 15 years. And so Jerome Powell spoke last week about how he doesn't want to repeat that situation. So we really need to see a weakening economy, which actually is a positive and it's counterintuitive. So this morning we had jolts, we had jobs reports. When we have strong economic data like strong labor market, strong job reports, usually it's good news, but it's actually bad news right now. It's counterintuitive because the Fed wants, quote unquote, permission to continue to raise rates because at the end of the day, what's most important to them is getting that inflation down. And, Jerome Powell even said last Friday, he said, households and businesses are going to experience some pain while we go through this process. And that obviously spooked the market. So when you look at what we were at, we ran really hard the months of, July and August, and we bounced significantly off the lows. If you look at the QQQ, it's trying to hold that $300 level, but it's kind of breaking through that. If you look on a chart, you're probably looking around $293 to complete a kind of a shorter term head and shoulders. It certainly can go much lower than that. We've been talking all year in the community here about how you could even see pre-pandemic levels on the QQQ of $235 and so on. So I think a lot of people get the misconception. They come to the channel, they don't watch the videos, they don't understand what we're all about, and they see something like top stocks to buy now and lower. You notice how the last video says now and lower. It's not saying go put your life savings in those 5 stocks. It's saying they're attracted to these levels, they could go lower and you're gonna buy them in dollar cost into those levels. So if you're thinking as a long-term investor, you're thinking, in my case, 2030 and beyond, I'm trying to accumulate shares in what I have most conviction in that I think is going to do well over the next 10 years. But I understand that right now you are fighting the Fed by buying. So, you can make the argument, I'm just going to sit and wait. Well, you saw what happened when the market does rip. It's really hard to get in. And so then people jump in and there's FOMO and that creates this run up. And then it starts to crumble down and then the same thing happens. It's just going to keep selling until all the sellers are exhausted. But it's really hard to time the bottom. And my job as an investor is not to try to time the bottom. My job is to try to build a blueprint, a portfolio that fits my needs and my suitability. And I'm trying to outperform over a period of time. Now, if you're watching TV, you're on social media, 95% of what you see out there, it's going to be focused on trading. They're really swing traders, even like CNBC, most of the stuff you see. And there's nothing wrong with trading. The problem is it's like oil and water when you think of long-term investors. And traders will make fun of you and say, oh, you're bag holding, and you just call it long-term investing and, yada, yada, yada. There's always that drama, and social media has only made that worse over the past several years. At the end of the day, when you think of long-term investors, you think of like the greats like a Peter Lynch. Peter Lynch wasn't buying hyper growth stocks. He was more of a value investor. But Peter Lynch had what he called clunkers, where he'd hold those in his portfolio for several years before they'd actually turn around. And sometimes he made the most profits on those type of companies that, took time. So long-term investing, sometimes the story takes time. And you might be right on the stock. The stock price doesn't necessarily mean the company's broken. It could just mean that the stock is broken. Even companies like Amazon, at one point Amazon lost 90% of its value and it rose from the dead. And you say, well, it's really hard to find the next Amazon. That's not my point. My point is there is going to be stocks that are down 80% right now that are going to give you 10, 20x returns. There's also a lot of stocks that are down 80% that are going to get cut in half again. And that could even go to zero and go bankrupt. So here's what I'm doing right now. I told this to the Discord community earlier this morning. I did make a few small nibbles today in the community portfolio, very small though, fractional shares like $50 at a time. And now I'm just sitting on my hands with the cash I have left. I'm waiting at lower levels. It doesn't mean it has to go lower. It could bottom any time. But let's look at this from a realistic point of view. Okay, earnings season. We're going to have earnings from some big tech names over the next couple of days. You know what they are. That could make the whole market move up or down. It really could. It could swing the market, especially when you think of like the cloud SaaS names. It could make that whole sector rally or crash, and it could bring down, broader sectors, even the market with it. Now, once these earnings reports are done, what catalyst do we really have that's going to be positive? Because the market really wants to see the Fed not be hawkish. And right now, that's all we see is the Fed saying, we'll do whatever it takes to get inflation down, which is very, very hawkish. Okay, so that's not good for the stock market. We keep having economic data come out that's positive, which is actually counterintuitively bad because it gives the permission again for the Fed to do what they got to do. And so until we see that, the market's going to continue to have volatility. We've said this all year. And I've been saying for a while, I don't think we're going to see new highs in the market until end of 2023. If it happens before then, I consider it a bonus. There's some guys out there like Tom Lee that think we're going to be at 4,800 at the end of this year. If that happens, great. I'm all for it. But I'm trying to be as realistic as I can to say, hey, man, it's not necessarily a bad thing. If I don't need this money right now and I'm thinking 2030, am I really upset if I can continue to buy the stocks? If I get another chance at some of these stocks to buy them lower? The problem is what I call fear of losing everything or full. There's so many people out there, especially traders, that don't have the correct discipline, psychology, and mindset to be an investor. There's only an elite few that really have it, that really understand the markets. And it comes back to financial education. It's why the rich continue to get richer, because they understand how the market works. And they understand, unfortunately, the market does a great job of transferring wealth to the patient, but really not only the patient, but the people that already have the education. And oftentimes those people are the people that already have the money. And so what it does is it continuously makes the poor poorer because they chase runs like we just had over the last couple of months. They buy things at the top. The market crashes. They get upset. They panic sell. They move on and they don't come back, or they come back at the next euphoric high or next all-time high in the market, rinse and repeat. If you can develop the mindset of, hey, the stock market, if you look at it, guys, the average bear market, this is off the top of my head, it's around 20 months in duration and about a negative 40% return, okay? Now, if you look at the average bull market, it's 51 months and 162% gain over 51 months. I did actually edit that part because I want to make sure I had the facts to you. 51 months, 162% gain. A bear market is 20 months on average and a negative 41% gain. So if you're accumulating shares and buying when everything's down during that bear market, if you buy the right companies, the highest conviction, highest quality that aren't going to go out of business, when that market turns around and gives you that bull run, that's where wealth's created. So wealth's really created in bear markets, but you realize the gains when you get to the bull run. And so what I'm doing right now, guys, is I'm just looking at individual stocks. I'm watching individual names. I'm watching some lower levels. Some of my favorite stocks look like on the charts they could go a lot lower. It doesn't mean they have to, but I think there's a good chance. And so I'm trying to do my best now to be disciplined, be patient, and try to just sit on my cash the best I can and wait for opportunities to come to me. I did buy some more shares in my main portfolio today on one stock, and it was incredible because a couple weeks ago this stock was $140, and I had people in Discord tell me, why don't you just pay it? It's a great company. It's still inexpensive here. It's way off the highs. And I said, hey, I think it go lower. Here's the areas I'm targeting. And, it kept going to those target ranges. I said I could go below 110. Boom, it did that today. Filled some more shares. Now I've got 60 shares in this company. My cost basis is only down about 5%, and I have room to add if it continues to go lower. Now I know that game is not for everybody. Some of you would rather just wait for the market to turn and catch it when it's on the way up. But you just saw what happens. You saw in July and August how hard that really is to do, because you don't really know if it's a fake out. By the time you decide that it's time to buy, it's 20% off the lows anyway. So at the end of the day, you got to do what's best for you as an investor. And if that means just sitting on cash and that's your strategy, and if you've got a short-term horizon, absolutely. If you're thinking 2030 and beyond, and you're disciplined with what you're building, your portfolio, you're not buying all spec stocks, stocks that could go out of business. You're buying high quality and high conviction, and you're managing your spec, you're managing your growth. You've got those dividend stocks in there. You've got your ETFs. You're building out the blueprint the way I teach it. If you're doing that, in my opinion, there's nothing better than to be buying when everybody else is afraid, especially targeted names. That last video I did, 5 stocks to buy now and lower that are beaten down between 55 and 85%. I said, don't put all your money in right now. These are just areas where it might be good to start nibbling, and you would buy on levels on the way down. I think some people miss that message and assume it just means take your paycheck and throw it all in those names. That's not what it means. And it's unfortunate because we live in a world where people want instant gratification on YouTube, on TikTok, or whatever. It's any social media app. And they want guys to come on, gals to come on that are gurus that say, buy this stock now, you're going to make a fortune, you're going to be rich tomorrow, and you're going to buy a Lamborghini. That's not what the stock market's all about. That's not what this channel is all about. This channel is focused on long-term investing, using growth to try to outperform over a period so you can reach financial independence at a certain point. And financial independence doesn't mean, lean fire, eating ramen noodles out of an RV. It doesn't mean sitting around watching TV all day. It means to live the life the way you want to live it. Most of us in our private community, we're focused more on fat fire, that 100K a year plus in passive income. We're doing that through dividends, fired up wealth. So fired, financial independence, retire early with dividends. You're using growth to outperform. You're selling that to buy blue chips and dividend passive income stocks that are going to pay you and give you a raise each year, because they're going to be DGI stocks, dividend growth investing, where they're going to raise that dividend, give you a raise, and you're going to outpace inflation and basically live off of your assets and never have to sell it if you don't want to. You never have to sell any of the stocks if you don't want to. So that's what I'm doing. My journey is to get to a $5 million taxable brokerage, right? And get to 100K plus in passive income by 2030. The portfolio, right now is sitting closer to 1.25 million, which, it's obviously down from its highs, but I'm still doing very, very well. I've been investing almost 25 years. And this portfolio, it's not like I've thrown a ton of money into it. It's been, something where I just started like you. Didn't have a ton of money. I didn't come for money. I just grinded, continuously invested, tried to buy quality companies, growth companies, and they've just grown over time. I've taken profits, shuffled those profits into other names and what have you. So, you look at the COVID lows. Since the COVID lows, even now, portfolio is up 250%, even after the massive, drop from the top. So, it's opportunity cost, and some people can't live with those, those blows, and they have this mental thing like, oh, I should have sold, exactly on November 10th, 2021, caught the top and sat on cash and then bought it back. That's all great if you can do that and time the market. But the reality is the guys that make a lot of money and the gals that make a lot of money in the stock market that have been doing it a long time, they're not generally timing the market. They might hedge, like a Warren Buffett might hedge using different options. But Warren Buffett's not necessarily liquidating his portfolio because he's getting paid dividends on that and so on. So it's different schools of thought. Unfortunately, the internet is going to convince you that the only right way is to be a get-rich-quick trader. And at the end of the day, that's what's going to be easily believed in this type of a market, where we're going to continuously have these disappointing rallies that fade. It's basically what we just experienced, guys. It was a bear market rally, and it was clear. If you've been in the market for a while, you know what it was. I was telling the gang, don't expect all-time highs. Don't chase this, So most of us weren't buying. We weren't buying over the last, month or so when everything got pretty hot, was running hard. We're kind of just sitting there waiting for specific names, for certain stocks to come back to areas where we're comfortable buying, and then buying. Sometimes we're buying a tenth at a time. So if you want $10,000 in a stock, you might buy 10 different lots, 1,000 at a time. Be very patient and disciplined. And that's really hard, especially if you started investing in the last couple of years, because you would just buy a stock and it would go up the next day, and it would go up the next day, and it would go up the next day. And you get in your mind, well, this is easy. You get that overconfidence effect. Now you get punched in the mouth, like, Mike Tyson says, everybody's got a plan until they get punched in the mouth. Now you got punched in the mouth, and you got to figure out, well, how does this really work? What's the market look like? Because I can assure you, 2020 and 2021 was nothing what an actual market looks like. You look at the S&P 500, if you're getting 10% a year, annual returns, The thing about that too is it's not consistently just 10%. You'll have a negative 20% year, a positive 30% year. It's all over the place. You got to look at it you're usually going to measure your success by decades, not by months, not by days. So if you're an investor that's thinking about 6 years from now and not 6 months from now, this is a great place for you. And our private community might even be a great fit. So check out patreon.com/firedupwealth. And this video was sponsored by the Motley Fool. They did not tell me what to create, what to make. They're a great partner and they give stock ideas. What we do at Fired Up Wealth is we teach you how to fish. We teach you how to dollar cost average. We take it a step further, how to build portfolios, things like that. So this video was sponsored by the Motley Fool. If you want to see the 10 best stocks to buy now, visit fool.com/firedupwealth. But guys, again, the QQQ right now, the next support line, if it breaks this 300 area, you're looking at $293, could always go lower. I'm dollar cost averaging the best I can, being as patient as I can, being disciplined and just understanding what's going on with the market. I appreciate your time and attention. Hope you have a great rest of your day. Take care.